So in the previous section, we had made a completely balanced balance sheet and a fully dynamic model. There are two other elements that can be added to this, which is we go back to the assumption sheet and go right at the bottom and create what is called as the debt schedule, right? Let's embolden it and say new long-term debt raised, long-term debt repaid, and net long-term debt raised. These are the three line items that come in. Now, we don't need to focus on the previous years. We need to focus only on these years, right? So these are the two assumption sheets that come in. And the third one is basically a calculation. So if I raise 100 crore and I pay 50 crore, then the net amount raised is 100 minus 50, correct? So those are the kind of calculations that come in. Once these calculations come in, we have to also assume interest cost as percentage of debt, right? So once again, we will go there only. And let's assume that interest cost for the debt would be about 10% for Maruti. So we stick to those numbers and keep them there, right? Now let's say Maruti raises some debt in this year of, let's say, about 500 odd crore, repays nothing this year, and then does not raise anything in the subsequent years, 0 and 0, but repays, let's say, 50 and 50 over these 2 years, right? That's the assumption. That's the assumption that we have taken. Now, this obviously needs to get incorporated into the numbers. We have not yet incorporated it. So this net long-term debt raised has to somehow get incorporated into the sheet of the data where the debt data is there. So that's the balance sheet data. Now my net non-current liabilities or long-term debt has to be 145 plus my assumption sheet 500, the net change. So that gives me the net change number, and I can then drag and drop this on the right side. You see, it raises 500 crores here. So it raises 500 crore here and then repays 50 and repays 50 here. So these are the changes that come in. Let's see if after these changes the balance sheet stays balanced. It doesn't. The balance sheet does not stay balanced because in our cash flow statement we have captured these change in loans, but there is some sort of a challenge in terms of our calculations that are happening. Let's find out where that issue is. Right? Let's find out where the issue is in terms of our overall calculation, and that's because here total non-current liabilities should change. That's because we have just equated it to the last year. If we take it as a sum of these four numbers, we will see that the numbers will automatically move ahead and make those changes. So what is the number that we see here now? The balance sheet balances. We already have the cash flow statement showing that you have taken a loan. This adds one more layer in terms of your overall work that is there. Now let's look at interest cost as a percentage of debt as well. 10% multiplied by the data. So here in the finance cost, I will take assumptions 10% multiplied by, remember interest cost is on both the long-term debt, which is 645, plus the short-term debt, which is 812 in our case, correct? So it is on both of these that we are accounting for the interest cost, and that gives us an interest cost of 146. Move it ahead. We have just made the changes in the interest cost that automatically would change the number that goes into the balance sheet and gets added here because the profit number will change, and that automatically changes the number that goes into the cash flow here because the profit number changes, thereby keeping the balance sheet balanced even after these changes. So now we have a model that links for any kind of assumptions. Let's say tomorrow Maruti comes and says we are going to raise 2000 crore of debt in this year. What is that going to do to their profitability? You see, the interest cost increases from 140 something to 338. And that is going to take away 200 crore or so from the profits. If I do a control Z, go back to the initial stage, 138 was the number, right? So that 2000 crore adds up an extra 200 crore of interest component to the overall business, and that gets captured dynamically at this point of time in this model. So we have created what is known as the debt schedule, and that captures this thing well. There's another schedule that needs to be captured, which is called the capex schedule. Right now, let's embolden this. The company may choose to mention some new capital expenditure, right? And this number could be, let's say, an assumption. We just put in some number here for argument's sake. And let's say we put this number as 1000 crore every year as capital expansion that the company assumes and says they are going to do. Now, when this happens, automatically you have to ensure that your depreciation calculations as percentage of net long-term assets last year. I have to calculate what is the depreciation percentage as a percentage of assets as last year, right? So I take depreciation for FY12 and divide it by the total fixed assets for the previous year. Why do I take last year? Is because I need to know on whatever assets were left at the end of last year, I would have paid depreciation this year, correct? So that's the depreciation percentage as a percentage of last year. I have not calculated this number correctly. We have to look at the P&L depreciation, which is here 1138 for FY12 divided by the balance sheet number here, which is 6381, and drag and drop this till here, and we find that every year whatever assets are left, roughly next year the depreciation number is 18% of that, right? So let's assume that these three are going to be 18% each, and once we put these three as 18% each, then we can go to the profit and loss account, and instead of linking this here, we can say FY16 depreciation is the same as 18% into FY15 total fixed assets, that is here, correct? So we calculate that and we get our depreciation number here, correct? And then we can drag it ahead. And now remember, the capex is also coming in. So what should happen is that on my balance sheet, this number, while removes the depreciation number of the year, should add any capex as well. So we go to the assumption sheet, add this 1000 crore here and link it ahead so that we get our 1000 crore every year. Now you see this is not getting captured. That's why the balance sheet is not getting balanced, and every year 1000, 1000, 1000 keeps getting extra, is because the capital expenditure does not get captured here. If I go here and link this as well to the assumption sheet and link these three data sets here, we will see that the balance sheet balances once again. Now, if the company comes and announces any kind of capital expenditure, you would have incorporated that directly into the work. So if they say we are going to do 10,000 crore of capex, you note that the cash flow will not allow them to do it. They are negative. So either they don't do it or they go and raise 4,000 crore of loan, in which case they're almost break even in terms of, so slightly higher number of loans like 4,300, and they should almost be breaking even, right? Maybe 4,500 will do the task for us. So if they want to do a capex of 10,000 crore, they need a loan of around 4,500 crore to be able to do it, right? And that is where the model becomes completely dynamically linked. Now, why can't they do it without that? Is because you can't end up with a negative cash number. You need to have a certain amount of money in your bank account to be able to carry out the capex that is there, correct? That's the calculation that has happened now. Now we have a completely interlinked financial model where if the company says that anything changes on their pricing front, anything changes on their production front, anything changes on their debt front, anything changes on their capital expenditure front, Everything gets captured in this model, and we end up with a completely balanced working model on the balance sheet. This can become the cornerstone as an extension for someone who's doing financial modeling and trying to create a model of valuation of Maruti, right? So that is the task that we have completed here in terms of creating a fully dynamically linked model.